Welcome back. You are with us on Trading Hour. Let's quickly get to the next conversation. Madanagopal Ramu from Sundaram Alternate Assets is with us to talk about the way forward for the market. Thanks very much for joining in. So let's start with how you are sizing up the earnings season and whether you think that corporates are showing enough juice in terms of EPS upgrades, profitability to keep this party going.
Thanks for this, and we feel that FY25 is going to be a tough year from an earnings point of view. You don't actually have any large macro tailwind that you had in FY24, like a commodity price fall that happened. So therefore, we see that many sectors will get into less than 10% sort of an earnings growth. Almost 75% of Nifty will have a 10% less than earnings growth. Q1 has started reflecting it. There are certain small surprises, but nothing big to take away. Therefore, we feel that earnings season is going to, starting from Q4, the earnings season even in FY25 is going to be weak. And therefore, we feel that that will keep the market also range bound and stable at the current level. So there isn't any positive surprises. Probably banks, which we expected will have some negative surprise because of margin pressure, did not have that. It was a small positive surprise, you can say. IT sector had a negative surprise, so that you can see in IT sector the way it is behaving. But overall, we feel that FY25 is going to be a year of muted growth for the entire Nifty.
Okay. What about, Bajaj Finance? I think that was one of your high conviction bets in one of your portfolios. Now, Bajaj Finance, the overhang appears to have been lifted, at least to some extent on the regulatory front. Is that a reason for you to top up your exposure?
See, overall, if you look at, we are quite positive on NBFC from a long-term perspective because NBFCs as an area, retail credit, they pay the retail credit, they grow much faster than the overall credit growth in India. So if you look at their growth can be even higher than 25% from a long-term perspective compared to private banks growing at around 15% credit growth. And PSU banks will be lower than that. So that's why we are always long-term positive on NBFC as a space. Bajaj Finance valuation went up very high, say 2 years back. So at that point, we reduced our exposure to Bajaj Finance. But today, when I look at the valuation, Bajaj Finance is today trading at closer to 7-year low in terms of price to book value. Bajaj Finance growth rates have not come down, and Bajaj Finance ROE has also not come down. They gave some bit of a warning in the last quarter earnings call, but nothing dramatic, I would say. It's a short-term pain because of the margin pressure being there due to the lag effect of cost of funds. It will normalize in the second half, and therefore, we feel that you are getting a franchisee which is capable of growing at 25% without much dilution in the margins or profitability from here. While on the other side, we find that PSU banks are at the peak of their profitability, at least from a medium-term perspective. So you should be worried about the profitability ratios holding on to the current level. But in case of NBFCs, particularly, which you asked for about Bajaj Finance, I think the pain will be for next 1 or 2 quarters. But beyond that, you are getting a franchisee growing at 25% and available at almost 4.5 times price to book value. That makes so anybody with a 3-year view should look at this space rather than focusing on pure value as an approach in the banking space.
Any changes that you've made to any of your funds, any stocks that you've added on, any stocks where you've done some profit booking?
So we have, one thing we discussed in the last call also, auto anch as a space looked very interesting. So I think some of the veterans in the auto space are also echoing what we are saying. While the entry-level car growth looks difficult to come through, you are seeing premiumization happening. And therefore, some of the auto anch companies are benefiting from because of this premiumization story, because their content per vehicle will almost double. So even if the auto sector grows at 7 to 8% volume growth, you can expect these companies to deliver closer to 15% sort of growth in volume level. And if the margins expand, they can deliver you a 20% growth, which is going to be difficult for OEMs to deliver such kind of a growth from a medium-term to long-term perspective. So that space looks good, and we have added 3-4 stocks in that space. And the other area where we have taken recent exposure is another auto company, but purely not auto play, but more of an industrial and emerging electric vehicle sort of a play, we can say, where we find that globally the electric vehicle, particularly the battery prices have come down almost 40-50%. And China is leading this. China is adding massive capacity and can keep the electric vehicle battery prices lower for a long period to come. And I think electric vehicle penetration in a country like India, which is at a very low level, can improve from here. So even if you take a 10-15% sort of an penetration, we see that some of the battery makers, the lead-acid battery makers, they are now starting to become attractive because the terminal value is now behind you. The terminal value issue is behind you. Therefore, they can ask for a reasonable valuation now. And on top of it, what is happening, some of this backup storage demand and inverter demand due to rooftop solar and inverter demand because of the power shortage that we are witnessing in India, all these are helping these these lead-acid battery players who are now not only about lead-acid battery, but a diversified business. So their valuations, which was very attractive because they were seen as a traditional business because of the focus on lead-acid, is now becoming very attractive. So that there we have added one of the ideas. So these are the changes that we have made to the portfolio.
Okay, all right, got that. We'll have to leave it on that note. A little short on time today, but we really appreciate you joining in and sharing some of those thoughts with us. Well, by the way, as we take the next break, the